Remember your time in elementary school? Some of your favorite days were probably field trips to the zoo and a museum. But for your parents, the best days were likely report card days. That's when they'd get a closer look at how well you might be shining in art class and maybe how much you were shining less in math class. Maybe that was just me. Anyhow, there's a parallel here for investors interested in picking stocks. You can think of a company's financial statements as report cards for their shareholders. And the way your parents would carefully review your report cards is a lot like what investors do during fundamental analysis. The three key reports that all publicly traded companies must provide are the income, balance, and cash flow statements. They're released each quarter and at the end of every fiscal year. Investors can compare the contents from quarter to quarter and year to year to track the performance of a company over time. They're indicators of how the business is shaping up, how it's doing relative to expectations, and how it stacks up against its competitors. These reports are also the source of many financial ratios that can help gauge the attractiveness of a stock's price. With all that said, let's get an overview of each one. Starting with an income statement, which can also be called a profit and loss or earnings statement. An income statement shows a company's revenue, expenses, and profits during the reporting period. Its main purpose is to illustrate the profitability of a company's activities. A company is considered profitable when its revenue is greater than its expenses. Generally, a stock becomes more attractive to investors as the company's profitability widens. An income statement helps answer questions like, how does this company make money? And what does it cost the company to produce its products? Next, the balance sheet. This is where a company reports its financial assets, liabilities, and shareholder equity at a specific moment in time. Its main purpose is to detail the financial health of a company. Like its name implies, a balance sheet must be even on both sides of the ledger. A company's total assets should always equal its liabilities plus its shareholder equity. A balance sheet helps answer questions like, can the company pay its short-term debts? And does the company have a positive net worth? Finally, let's check out the cash flow statement. It measures the money moving into and out of a company during the reporting period. When a company receives cash in its account, say when a customer pays for one of its products or it's paid a royalty, that's called an inflow. And when a company spends cash from its accounts, like when it pays for an order from a supplier, that's an outflow. A firm's ability to generate positive cash flow is important. It means the company can afford to pay down its immediate expenses, reinvest in the business, and ultimately return money to shareholders. The cash flow statement helps explain to investors how much money does the company actually have in its possession at this time, and might this company have money on hand if it needed it unexpectedly? Okay, so that's a brief overview of the three key financial statements. Now, it's important to keep in mind that context is key when analyzing them. For one, investors would need to understand a company's business model before poring over these reports. Otherwise, they might misinterpret the information presented. For example, a company's business might be seasonal in nature. If an investor didn't know that beforehand, they might mistake lower profit during the company's off-season as a sign it's struggling. Second, businesses in one sector or country might have different ways of reporting their finances than those in another. They might group certain types of expenses into a single category or label their revenues uniquely. That's why sound fundamental analysis usually involves comparing a company's results to others in its industry and geography. It's a similar story with the way financial results are accounted for in the statements. There's the standard generally accepted accounting principles, or GAAP, and company adjusted or non-GAAP. Make sure you're comparing apples to apples. Lastly, remember that financial statements might not capture everything about a business. Important factors like product developments, management changes, and business conditions aren't included. Investors may wish to follow news about the company and the broader economy as part of their fundamental analysis. These are examples of qualitative metrics that aren't as easy to measure. They matter too. Now that you're more familiar with the basics of financial statements, let's dive into the specifics. Check out our lessons on income, balance, and cash flow reports to learn how to read each one in detail.